Everyone today talks about digital scarcity. There will only ever be 21 million bitcoins. That number, hard-coded, finite, has become a religion for some. But long before Satoshi, before servers and blockchains, there was something even more limited, tangible, ancient, and far more violent: land. Not real estate, not condos or mortgages or property portfolios. I mean land as power, land as monopoly, land as the first and ultimate store of value, the original Bitcoin. Because unlike paper money or code, land can't be printed, it can't be replicated. It's the one asset that monarchs, empires, bankers, and billionaires all quietly agree on. When everything else burns, you retreat to land. But here's the paradox. In every official history, the rise of nations, revolutions, and even industrial growth is credited to things like democracy, capitalism, or technology. That's the surface layer. Scratch it, and you find something far more blunt. Someone got land, someone lost it, and everything changed. The French Revolution wasn't about liberté, it was about the national confiscation and sale of church lands in 1789, called the biens nationaux. Those lands were auctioned to raise money to pay off the bankrupt state. In return, France issued a new paper currency, the assignat. That's what fueled the revolution: land monetized into promises. The enclosure movement in England, not a noble evolution toward agriculture efficiency, it was theft. Lords fenced off peasant commons, turned subsistence plots into profit-driven sheep farms, and printed titles to back their claims. Even in America, the Founding Fathers weren't just fighting for liberty, they were fighting to unlock millions of acres of native land west of the Appalachians. George Washington owned over 50,000 acres before he was president, and in every case, the mechanism is the same. Land gets financialized, measured, sold, rehypothecated, turned into bonds or leases or mortgages. The scarcity becomes liquid. And those holding the title, whether aristocrats, corporations, or central banks, sit on wealth that multiplies without labor. The rest of us? We pay rent. If you're wondering why billionaires still buy farmland in 2025, why BlackRock is buying up neighborhoods, or why wars still redraw borders even in the rules-based international order, this is why. Because while the internet debates which altcoin is the next big thing, the real elite already bought theirs. It just doesn't live on the blockchain. It lives under your feet. To understand why land is the true Bitcoin, scarce, silent, and violently defended, we have to go back. Not just decades, centuries. Because long before algorithms enforced digital scarcity, kings enforced physical scarcity. And the story of land as power begins with a very human problem: how to extract wealth without working for it. In medieval Europe, land wasn't an investment. It was the system. The king granted it to nobles, the nobles extracted labor from peasants, and peasants had no choice. They couldn't move, they couldn't vote, they couldn't own. The value of land wasn't just the soil, it was the obedience attached to it, the monopoly on survival. But then came a shift. In the 16th century, Europe discovered gold in the New World. Spain flooded back from the Americas with silver bars, triggering inflation across the continent. Suddenly, power based on land alone wasn't enough. You needed liquidity, coin, capital. That's when a new idea began to creep in. Land could be financialized. Take England. In 1536, under Henry VIII, something radical happened. The dissolution of the monasteries tore church lands from the hands of monks, roughly 1/3 of England's total land, and redistributed them to nobles and loyal bureaucrats. But this wasn't just about loyalty. It was economic warfare. The crown was broke. The land was collateral. By the early 1600s, you had the rise of entails, leases, rents, and land-backed credit. Title deeds became negotiable instruments. This meant you didn't have to sell your estate. You could borrow against it. And just like that, land became liquid capital, the same way modern real estate is today. Banks, especially in Amsterdam and later London, understood this immediately. They weren't just lending money, they were lending against land. Titles became trust, trust became money, and money became power. When the Bank of England was founded in 1694, it didn't lend out piles of gold, it lent against government promises, which were themselves backed by tax revenues, which came from land. Now step back and look at the machine. The king grants land, the land is titled, the title becomes collateral, the collateral becomes a bond, the bond is bought by banks, the banks create credit, the credit buys more land. It's circular, a closed loop. And if you're not inside it, you're the one paying interest, paying rent, paying tax. This is what made the British Empire possible. The East India Company, the most powerful corporation in history, didn't conquer India with cash. It conquered with charters, grants of monopoly land, and trading rights from the crown. Then it taxed Indian farmers on their own land, extracted the wealth, and used that revenue to fund more military expansion, all while paying dividends to shareholders in London. Even slavery was a land system. The plantations in the Caribbean and the American South were valued not just for sugar or cotton, but for the slaves themselves, counted as movable property. Those assets were borrowed against, insured, bundled into paper claims traded in London, Paris, and Amsterdam. Everything becomes paper once trust is established, and trust back then meant land. Today, we think of central banks as the core of the financial system. But ask yourself, what gives a central bank its true power? It's not the vault, it's the state. And what does the state control? Land, law, and tax. The same triangle that's ruled empires for 500 years. Bitcoin may be scarce, but it relies on code and consensus. Land relies on courts, armies, and guns. One is enforced by miners, the other by sheriffs. That's not a metaphor. In 1819, during the panic in the U.S., local sheriffs evicted thousands of farmers from their land when they couldn't pay debts denominated in gold. In 2008, it was banks doing the same with mortgage-backed securities. Different instruments, same mechanism. If you've ever wondered why history keeps repeating, bubbles, crashes, repossessions, it's because the land machine never went away. It just got more abstract, more polite, and far more global. Once land became paper, the illusion was complete, because suddenly what was once immovable, fixed, and painfully slow to transact now became fast, flexible, and dangerously scalable. This is the moment when land stopped being about farming and became about finance. Take 18th century France. After the revolution in 1789, the new government was broke. They had executed their king, dissolved the ancien regime, and inherited an ocean of debt. But they had one thing left: land. Specifically, the expropriated lands of the Catholic Church, millions of hectares across the country. The solution? Monetize it. They issued a new currency, the assignat, backed by this national land. At first, it made sense. You could redeem the paper for real property, solid value, Bitcoin with vineyards. But then, like every government pressed for funds, they issued more and more, until the assignat was no longer backed by anything but belief. Within 5 years, the paper collapsed in value. Bread prices soared. Inflation turned into famine. And trust, once broken, could not be printed back into existence. That's the illusion phase. It always feels like growth until it doesn't. Now look across the channel. In Britain, the 18th and 19th centuries saw the rise of what textbooks call the agricultural revolution. But under the surface, it was a land grab. Parliament passed enclosure acts, turning open, peasant-shared lands into privatized, fenced-off estates. Over 5,000 such acts passed between 1604 and 1914. The result? The aristocracy grew wealthier not by growing food, but by owning land as rent-generating capital. Peasants became laborers, families migrated to cities, and landowners could now borrow against their property, issuing bonds, building estates, and speculating on the rising value of what was, essentially, soil with legal paperwork. By the 1800s, British land wasn't just valuable, it was liquid. A gentleman in Yorkshire could raise capital on his estate and invest in Indian railroads. A banker in London could bundle mortgages into securities. Sound familiar? In America, the illusion took a different form, the frontier. Between 1800 and 1900, the U.S. government gave away or sold over 1 billion acres of land. It was framed as freedom, manifest destiny, the right to homestead. But the underlying mechanism was brutally consistent. First, native lands were seized, often by force or broken treaties, then surveyed, parceled, and granted to settlers or sold to speculators. Railroads were given vast strips of land as incentives. Entire states were financed on the back of land sales. The result was explosive. Towns popped up overnight. Prices soared. Everyone believed the same lie. Land always goes up. Banks loaned freely against it. The General Land Office couldn't process claims fast enough. Maps were printed before towns existed. But when prices fell, as they did after the Panic of 1837, the Panic of 1873, and the crash of 1893, the illusion shattered. Farmers defaulted, railroads collapsed, banks failed, because the land didn't vanish, but its price did. And that's the hidden truth of this entire period. Land creates the illusion of stability. You can walk on it, fence it, farm it, but the value of land is always based on flows: credit, trust, rent, and expansion. And during a boom, it looks infinite. People start believing it's a ladder anyone can climb. They forget someone's holding the rope. By the early 20th century, this illusion reached its peak. Suburbs began to rise, mortgages became standardized. The American dream, a house on a plot of land, was marketed not as a luxury, but as a right, backed by the government, financed by banks, guaranteed by growth. No one asked the question, what happens when the land is gone? When the expansion ends? When the paper multiplies faster than the soil? They didn't need to. Growth made it feel eternal. And for a while, it was. If this helped you see the boom not as progress, but as prelude, tag someone who still thinks real estate is passive income. Every boom built on land ends the same way. Not with fire, not with revolution, with arithmetic. Because land may be finite, but the claims on land are infinite. Paper multiplies, hopes multiply, loans multiply, and eventually the numbers floating above the soil grow larger than the soil itself. Then the system snaps. Look at the United States in 1929. The stock market crash is the headline. The land collapse is the story. Between 1920 and 1925, Florida real estate prices ballooned by thousands of %. Miami was being advertised in Chicago newspapers as the new Mediterranean. People bought plots they never saw, with money they never had, betting on buyers who didn't exist. The railroads couldn't even deliver enough building materials because the infrastructure hadn't caught up with the speculation. By 1926, the illusion cracked. Hurricanes hit, credit tightened, prices fell. The Florida land bust became the first domino that would, 3 years later, help topple the entire global economy. But history books blame Wall Street greed, as if the skyscrapers were the disease and not the fever. The deeper cause was simpler. Mortgages and land-backed loans collapsed. Banks failed, money disappeared, and suddenly millions who had believed in the promise of rising soil found themselves underwater while standing on dry land. Arithmetic always wins. The same pattern held in Japan in the 1980s. At the top of the bubble in 1989, the grounds of the Imperial Palace in Tokyo were said to be worth more than all the real estate in California. Bankers repeated it like gospel. Land prices quadrupled. Loans expanded. Corporations borrowed against rising land values to buy more land, which raised the value again, which enabled more borrowing. It was a spiral, a beautiful, rational, self-reinforcing spiral, until one day it wasn't. When the Bank of Japan tightened credit, land values stopped rising, and when they stopped rising, the collateral evaporated. Suddenly, every loan was overvalued, every balance sheet lied, and every bank was exposed. The collapse wiped out 2 decades of growth. By 1991, Tokyo land prices began a fall that would last for 13 straight years. An entire generation learned the hard truth. Land doesn't always go up, but the debt attached to it always comes due. And then, the most familiar example, 2008. The global financial crisis wasn't triggered by housing. That's too broad. It was triggered by a specific mechanism. Financial institutions printed more claims on houses than houses themselves could justify. Mortgages were sliced, bundled, bet on, and sold like 18th century assignats. Banks treated land-backed loans as risk-free. Homeowners believed they could refinance forever. Governments believed rising property values guaranteed prosperity. But the price of land is not the land, it is trust. And trust died when homeowners defaulted in numbers too large for the system to absorb. Arithmetic again. Behind every eviction in 2008 was a spreadsheet. Behind every toxic asset was a deed. Behind every collapsed bank was a pile of claims on land that no longer matched reality. And that's the real pattern here. The collapse never comes from ideology. It never comes from politics. It comes when the paper representing land grows faster than the land itself. France in the 1790s, America in the 1830s, Britain in the 1870s, Japan in 1991, the entire world in 2008. All different eras, different technologies, different excuses, same math. You can stretch trust, you can stretch credit, you can even stretch belief, but you cannot stretch land. And when the system forgets this, collapse is simply the moment the soil stops agreeing with the numbers printed above it. The numbers broke, the banks fell, and still, the system didn't die. Because when land collapses, power doesn't disappear, it consolidates. 2008 didn't end the land game, it rebooted it. And the consequences are exactly what you'd expect when the monopoly board gets flipped mid-game. The players with the most cash start buying everything. Let's walk through it. After the crash, central banks flooded the world with money. 0% interest rates, trillions in quantitative easing. That didn't go into wages, it went into assets. And the safest asset, the one every institution, pension fund, billionaire, and private equity giant agreed on, was land. Not land for farming, not even land for living, but land as yield. Land became the bond market. Companies like Blackstone and BlackRock began buying entire neighborhoods. Not houses, neighborhoods. Post-foreclosure, post-crisis, post-shock, they acquired properties by the thousand. They turned former homeowners into permanent renters. And then they packaged those rent flows into new securities, just like the old mortgage bonds, but this time with a corporate landlord at the top. The same system, slightly adjusted, slightly colder. In the countryside, billionaire investors quietly began buying farmland. Bill Gates became the largest private farmland owner in the US with over 275,000 acres. Hedge funds began betting on water rights. Tech billionaires bought up entire islands, ranches, and emergency compounds. The rationale? Security, scarcity, resilience. But it's the same story dressed in postmodern clothes. Land is still the collateral, still the base layer, still the asset that no one can print. Meanwhile, for the rest of us, ownership has drifted out of reach. In cities from Toronto to Sydney, London to Seoul, homes are now financial products. Developers build for investors, not families. Empty towers stand lit but lifeless, priced not for occupation but for speculation. Rent is extracted like a tax. Wages don't keep up. Generational wealth now starts with a down payment, from your parents if you're lucky. And in the global south, the dynamic is harsher. Multinational agribusiness firms lease or buy massive tracts of land in Africa, Southeast Asia, and Latin America, often at fire sale prices from cash-strapped governments. It's called land leasing. In reality, it's resource extraction. Locals are displaced, crops are exported. The profit flows to London, New York, or Singapore. Not so different from what the East India Company did, just without the uniforms. Now step back and see it clearly. The illusion of democracy, of open markets, of equal opportunity, all rests on a foundation owned by fewer and fewer hands. Digital tools distract, political rhetoric divides, but the real game still happens beneath our feet. Even your phone reminds you, buy land in the metaverse. It's a joke, but not really. The same scarcity logic applies. People will speculate on fake land because real land is already cornered. And the state? It doesn't challenge this. It enables it. Zoning laws, tax codes, subsidies, and bailouts all reward those who own. Property tax breaks go to landlords, not tenants. When housing crashes, the state rescues banks, not homeowners. When land is inflated, your rent rises, but your wages don't. And if you try to squat, build, or protest, that's when you'll meet the real enforcer, not the market, but the sheriff. Because land isn't just economic, it's legal, it's political, it's enforced by violence if needed, just like it always was. From serfdom to suburbia, the machine continues, but now it's global, digitized, algorithmic, dressed in the language of prosperity. And most people don't even realize they're in it. Land doesn't care about your ideology. It doesn't care if you're a capitalist, a socialist, a libertarian, or apolitical. It just sits there, scarce, silent, and waiting to be claimed. And in every era, someone does claim it. Then they build systems, laws, and beliefs around that claim to make it look natural. But it isn't natural, it's engineered, and that's the point. Bitcoin may be a breakthrough. AI may change everything, but land, the dirt under all our inventions, still follows the oldest law in economics. What is scarce accumulates power. And when that power isn't limited by trust, ethics, or math, it always collapses into rent-seeking, monopoly, and eventually, revolt. Not because people are evil, but because systems built on scarcity eventually reach a point where the numbers no longer work for most of the population. Then people rebel, not out of ideology, but out of arithmetic. They can't afford to live. That's when regimes fall. It happened in France with the assignats. It happened in Britain after the enclosure riots. It happened in the United States when millions lost their homes in 2008, while the asset holders got richer. And it will happen again, in new forms with new names. Because unless we confront the structure, who owns the base layer, who controls the rights to live on it, and how those rights are enforced, we're just watching history rerun in high resolution. Land is not just real estate. It's the original economic protocol. And unless we understand that, we'll keep getting rugged, not by markets, but by math. So remember this. Systems don't collapse because of bad intentions. They collapse when the numbers outgrow the gold, the land, or the trust they were built on. If this gave you a new lens on history and on what's coming, share it, speak it, save it. Someone out there still thinks land is just where you live. Let them know it's where the empire lives too.